I received an email from a viewer of the channel asking me to try the triple RSI strategy. The reason for the question is I have published many videos on the channel that use the RSI indicator. And I built many strategies, many variations of the RSI. Now, the RSI been so good for the past 5 years, it's been printing money every single year. So, no jinx, let's hope it continues. Now, after looking at some videos that use the triple RSI strategy, I found they all have something in common that is fundamentally wrong. So in this video, I will show you what's wrong with these strategies and how to properly build an RSI strategy. If you are not familiar with the RSI indicator, please search my channel for RSI strategy. You will have at least 20 videos showing you different strategies using the RSI indicator. The RSI indicator is an oscillator that goes to overbought and oversold. And basically, you're supposed to short the overbought and buy the oversold. But you should not do it blindly on any market. And I discussed this in the previous video with the market edge. So every market has an edge and you should match that strategy with the edge. So in the case of the RSI, since we want to buy the oversold, so that means we are buying pullback. And the best market for pullback is usually the stocks and definitely stock indexes. Now, all my strategies on the channel that uses the RSI usually on the S&P 500. It is the best market for a pullback strategy. So the first triple RSI strategy we will discuss is this. So basically, the guy is stuffing 3 RSIs as a signal to go long. The problem with this kind of strategy is, well, if you are using different periods, so definitely the last period, so the RSI 21, when it's below level, the faster periods will also be below that level. So that makes them obsolete because they're doing nothing. And here is the illustration. So the green line is the RSI 7, and the pink line is the RSI 14, and the red line is the RSI 21. And as you can see, whenever the RSI 21, the red one, whenever it peaks down, the other RSI are definitely peaking down. So if this one here, this is a peak down, so definitely both of them are below this level. And when it peaks up, it's the same thing. Definitely these two are above that level. So in that case, if you include this RSI 21 in a signal, then these two means nothing because they will always confirm this one. And if you are using this one, the short period, and waiting for a confirmation from the long one, again, this makes it obsolete because you're always waiting for this one. So I would not waste more time on this strategy and we'll just skip it because, again, it doesn't mean anything. The other strategy that I found a little bit interesting is this one, which is they are using, again, triple RSI, but in a different way. Just to illustrate it, so this is the S&P 500, this is the RSI 2, and these are the rules for the strategy. The RSI below 25, and then the RSI lower than the previous RSI for 3 bars, and then the RSI is below 63 bars ago, and then the close is above the 200-day moving average. The exit is the RSI above 60. Now, I added this 6 bars. The original strategy did not have this, but if you don't add this, then you'll have a big problem. This problem is on all mean reversion strategies. This is the best way to illustrate it. So imagine you took this signal. So the RSI goes below a level, so you are shorting here. And then you are waiting for the RSI to go above this level. So if you short here, it doesn't go above the level until this bar. So you see, this is a big drawdown. Same thing here. So let's say we shorted here because it's below the level. And then I'm staying short. There is no exit, no exit, no exit until this bar. And this could stay a long time. So with mean reversion strategies, you need to have some kind of exit. Usually it's a short-term indicator that flips up and down, or a stop loss, or a fixed number of bars. A fixed number of bars to me is the best exit because it's not optimized, and for short-term trading, anything between 3 to 7 bars is good. You can optimize this, but anything between 3 and 7 will work for short-term strategy. So going back to the strategy, I added 6 bars as an exit. Now you also notice I didn't put a period here for the RSI look back. And the reason for that is I just want to show you that this will work regardless of the RSI period. Now up to a point, because you cannot put RSI 21 here and expect it to be a strategy, because as you can see, RSI 1 doesn't have many signals. So this is 14, and again you see there are not many signals. So you need short period. So anything here between 2 and 7 will work. So to prove my point, I used the same rules in the strategy and I just changed the look back. So this is 2, 3, 4, all the way to 7. And as you can see, all of them are making money. Of course, we have different number of trades, different average trade, and different return to drawdown. But still, just to show you that they all make money, because the S&P 500 will actually work with any long signal. It is really hard to come up with a losing strategy going long on the S&P 500. You only need to manage risk. In this case, we are managing risk by exiting after 6 days, or if the RSI is above 60. So when we are using RSI 7, that means we are using RSI 7 below 25, RSI 7 lower than the previous RSI 7 for 3 bars, RSI 7 below 60 3 bars ago, and we are exiting when RSI 7 above 60. And the same goes for all these RSI. So this is just to prove to you that the RSI will make money regardless what you do on the S&P 500. In fact, any pullback will make money. Now you can go deeper into the subject why the S&P 500 makes money with any signal that goes long. And in fact, I have a video that tests the S&P 500 randomly going long, and on average you will make money. As I told you in the beginning of the video, most of these strategies suffer from something fundamentally wrong. If we look at these conditions, let's look at this. So the RSI below 25. So this is a signal. The RSI below the previous RSI for 3 bars. Again, this is a signal. But the RSI below 60, this is kind of a regime filter. Because let's think about this. So above 60, we are, let's say, in bull market. Below 60, we are in bear market. And the close above the SMA 200, this is definitely a directional filter. So what we have here is 2 signals and 2 filters. Because both of these filters are directional filters, and then both of these are pullback signals. And again, I will prove this to you. So let's test this strategy with only this signal. So the RSI below 25, and then we will exit when the RSI above 60 or 6 bars. And we will remove the other conditions. So if we use the RSI 5 below 25, we get $47,000 and profit factor of 1 to 2, return to drawdown 1.1. Number of trades 172, we are making $278. The data here I have since 2006, and I'm using the E-mini futures on the S&P 500. Now, if we use the second signal, so again, same exit, but now we're using the second signal to enter, and we remove all the other conditions. 198 trades, and we're making a bigger average trade, which of course will be reflected in the net profit. So here we have 1.9 return to drawdown ratio, 1.6 profit factor, and we are making about 110,000. And so you see already I am much better off by removing the other conditions, because these are overfitting. This is what looks to me. These 2 conditions are filters. These 2 are signals. What we are doing here basically is we are trying to overfit for some conditions, but removing all the conditions are much better. In fact, we're already ahead by just using the signal and just adding the 6 bars as an exit. Now, that doesn't mean filters are not good. In fact, the basic anatomy of any strategy is an entry signal, an exit signal, and a filter in the middle. But I'm just trying to show you that separating the signals is much better than adding them together, because most likely you're doing nothing by adding them except you are overfitting. And again, adding 2 directional filters, most likely you're just overfitting. It's much better to use only one of them. But now that we separated the signal, we can easily now add a filter to make the strategy better. And since we are adding a filter, we can test million filters for the same strategy. But let's go with the original strategy and let's add one filter at a time. So this is the original strategy, and we have 172 trades. And let's add this filter first, which is the RSI 5 below 63 bars ago. So our number of trades goes to 148, and we are making less money and worse return to drawdown. So let's remove this filter and add this filter. So this is a much better filter. We make more money, 62, return to drawdown is much better. And let's look at the trades. We filtered about 50 trades. We increase our average trade. So this is a much better filter. So this is the RSI 5 below 25 with the close above the 200-day moving average. Like I told you, this is also a signal, and now we can test it. So now let's test this signal with these two filters. So this is the RSI below the previous RSI for 3 bars. The signal alone, we have about 200 trades with 63% win rate and about 550 on average. Let's add the first filter. We filtered about half the trades. We're making less money, still not a good return to drawdown ratio. Now let's use the other filter. And this is much better than the previous one. So this signal works better with this filter. You see here we are making 92, but now our return to drawdown is up to 3. 131 trades, bigger average trade, a little bit lower win rate. And so by separating the signals and the filters, first of all, we get much better idea what's working and what's not. And then we will have more confidence in the strategy when we trade it live. Because now we understand that this signal is doing this filter is doing this. And instead of just adding a lot of signals, a lot of filters, and hoping that the strategy will do better in the future. So a much better way to build an RSI strategy is to start with a signal for entry, a signal for exit, and test multiple filters. So in this case, I will go with the RSI below 25 as our entry, the RSI above 60 as our exit, and if that doesn't happen within 6 bars, we will exit. And we will remove all these conditions. And then we will test the strategy with different filters to see what we get. Now, the lower the RSI number like this is the RSI 2, the more signals you will get, which is much better because then you can filter them and still end up with a good number of trades. So here is the optimization. This is the RSI 2, below 30 we go long, and above 60 we exit with 6 bars fixed exit. And this is our original strategy. You can see we are making 220,000 with 4.46 return to drawdown ratio, 72% win rate. And you notice we have above 100 strategies already making better return to drawdown ratio just by using different filters. So look at this one. This is making more money and much better drawdown, which gives us a double return to drawdown ratio, a higher win rate, and still end up with 300 trades. So this is an excellent filter without over optimizing and adding more signals, adding double filters, just using a single filter. In fact, like I showed you, we have above 100 filters that are doing very, very well. This is the strategy with the filter, 308 trades with an average of 750. And like I mentioned in the beginning of the video, the past 5 years, the RSI been printing money on the indexes. The key takeaway is do not fall in the trap of overfitting by adding more signals and more filters and overfitting to try to come up with a good strategy. Always start with a simple entry signal, a simple exit signal, and then try different filters. That's usually the nucleus of a robust strategy. If you like this video, then you will love the next one.